Hello, this is Eric DeCarbonell from MarketSkeptics.com. This is the second part of my video on how government financial innovation caused the 2008 financial crisis. So far, in the first video, I went to the FDIC's website and then used Managing the Crisis, Chapter 16, to show that the government is deeply involved in financial innovation. In this video, I want to talk about the government's other critical contributions to the 2008 financial crisis. I'll start with how the government created the entire infrastructure necessary for the subprime market to function. So let's have a look at another section of the FDIC's website. The FDIC hosted the day-and-a-half symposium in 1998 to examine the FDIC and the RTC's experience during the savings and loan crisis. And the part that interests us is Panel 2 on asset disposition. In this panel, investment banker Deanna Reeves gives us a list of what the RTC has created in the fixed income securities market. First, there used to be many trading desks and firms that did not have the expertise nor the time to sell securities that had a complex story. In other words, Wall Street used to have better things to do than to disguise and sell toxic debt. The RTC experience pushed us all to develop skills we would not have had otherwise. In other words, an entire generation of Wall Street executives were trained to turn toxic debt into gold. And after the RTC was over, those executives went on to create the subprime crisis. Second, the RTC created the early commercial mortgage-backed securities market, forced the setting of standards of due diligence, and focused the rating agencies on this market. In other words, the government helped Wall Street create the procedures to safely sell toxic debt, and it got the rating agencies to rate what should never have been rated in the first place. Third, the street today is more willing to take principal risk for assets that can be placed into securitization. There are more firms today willing to look at unusual assets and commit their own capital. In other words, the RTC increased Wall Street risk-taking. Fourth, the enhancement of systems and financial modeling. Very advanced financial engineering was required to model many of the RTC's transactions, which included new structural twists, new assets types, and new credit enhancement method. Most of the Wall Street firms have vastly improved financial engineering models today if they were involved with the RTC process. Those vastly improved engineering models are what helped cause the financial crisis. Let's finish this by looking at Tainted Legacy, the article I talked about in my last video. Omitted from the RTC's legacy, in high irony, is its role familiarizing Wall Street with the methods of securitizing non-standard and potentially risky assets. The RTC generated a lot of revenues that allowed these firms to bulk up their mortgage securities business. It let them afford the research, the analytics, the trading desks, hire 10 or 20 people. The securitization expertise available to Wall Street only increased after the RTC's dissolution in 1996. Again, the entire infrastructure necessary for the subprime market to function was built up under the RTC. It could not have happened naturally in the market. Alright, next let's look at how the federal government decimated state authority to regulate the financial sector. Here I'm going to use a well-written article on Blogger Base. State regulatory authority was largely responsible for providing business and consumers a stable economic environment for the 50 years following the Great Depression. But beginning in the 1970s, Congress decided that it would preempt certain state laws, and by the beginning of this decade, they had pretty much decimated state authority to regulate businesses in the financial sector. To understand how preemption of state rights undermined the U.S. economy, a great example comes from state bucket shop laws. Bucket shops sprang up all around the country in the late 1800s. They were essentially betting parlors that allowed you to bet on stock prices. You could walk into a bucket shop and place a bet that a particular stock would go up or down without ever buying the stock. By 1929, bucket shops were illegal in virtually every state in the country. The reason states outlawed bucket shops was because they could buy or sell large blocks of stocks and manipulate stock prices. This meant that if a lot of their clients were betting on a stock going up in price, they could sell a large block of stock in that company. This would cause the stock price to fall and allow them to keep all their investors' money. In other words, they were fraudsters. What the bucket shops were selling are what we commonly refer to as derivatives. Another phrase for them is credit default swap. just like the mortgage credit default swaps that started the market meltdown last year. These are the worthless securities that have caused banks to go broke and made the government the largest holder of AIG. So how is it that even though bucket shops are against the law in most states, that companies like AIG were able to sell credit default swaps? Well, that's because President Clinton signed into law the Commodity Futures Modernization Act of 2000, which contained a line that read, "This act shall supersede and preempt the application of any state or local law that prohibits or regulates gaming or the operation of bucket shops." With the stroke of a pen, President Clinton and Congress used their regulatory authority to completely deregulate a large market. A market that had been considered so important to financial stability that a century earlier it had been regulated out of existence. 60 Minutes also did a piece on this. In retrospect, giving Wall Street immunity from state gambling laws and legalizing activity that had been banned for most of the 20th century should have given lawmakers pause. Alright, let's go to the next one on our list. Protecting subprime lenders from prosecution. Here's a Washington Post article written by Elliot Spitzer. Several years ago, state attorney generals and others involved in consumer protection began to notice a marked increase in a range of predatory lending practices by mortgage lenders. Even though predatory lending was becoming a national problem, the government chose instead to align itself with the banks that were victimizing consumers. The predatory lending threat was so clear that all 50 state attorney generals joined together in an attempt to fill the void left by the federal government. Several state legislatures enacted laws aimed at curbing the practices. What was the Bush administration's response? Not only did the Bush administration do nothing to protect consumers, it embarked on an aggressive and unprecedented campaign to prevent states from protecting their residents from the very problems to which the federal government was turning a blind eye. In 2003, during the height of the predatory lending crisis, the controller of the currency invoked a clause from an 1863 National Bank Act to issue formal opinions preempting all state predatory lending laws. The federal government's actions were so egregious and so unprecedented that all 50 state attorney generals and all 50 state banking superintendents actively fought the new rule. When history tells the story of the subprime lending crisis and recounts its devastating effects, the Bush administration will be judged as a willing accomplice to the lenders. Now let's look at how the government encouraged banks to buy toxic CDOs and get rid of safer assets. Here's an article by City AM that shows how a secret rule caused the crisis. Slowly but surely, some economists are beginning to piece together the real causes of the crisis. And as you might imagine, their findings are strikingly at odds with the conventional explanations, which tend to revolve around greed, bankers' animal spirits, and deceit. For one, the U.S. amended the accord which governs banks' capital with the so-called recourse. U.S. retail banks were required to retain just $2 in capital for every 100 invested in AAA-rated CDOs, compared to $5 for the same amount in actual mortgage loans and in commercial loans. The recourse rule, pushed through by the Fed and other regulators, was deliberately designed to steer bank funds into CDOs, and it worked like a treat. As far as banks were concerned, they were merely following the new best practice. The recourse rule only covered commercial banks. Hedge funds, insurers, and others were not cajoled into buying CDOs. It is clear that U.S. authorities were therefore not only complicit, but also directly responsible for the destruction of the U.S. banking system. Their rule also helped inflate demand for CDOs, securitization, and even subprime mortgages. And there you have the government's other critical contributions to the 2008 financial crisis. Now, to end this video, I want to go back to where I started, which is the nonsense you hear repeated everywhere in the US media, particularly the idea of a lack of oversight. You must understand, accusing the government of a lack of oversight in the financial crisis is like accusing O.J. Simpson of a lack of oversight in the death of his wife. So how do you make sense of something so absurd? Well, in other countries, when the media reports the opposite of the truth to protect the government, it's called government propaganda. A strange concept, I know. But please ask yourself if it's possible to write an entire book about the financial crisis and not find anything the government has done wrong.